You've been told to pay yourself a salary. But what if I told you that same advice that you have been ignoring is actually costing you about $11,000 every single year in taxes? When you're self-employed and file as a sole proprietor, you'll file your business tax return on a Schedule C, which is in your 1040 personal tax return. And when you operate your business this way, 100% of your business profits are subject to self-employment taxes, which are 15.3%, and that's before ordinary income taxes that you normally see on your tax return even kick in. So that means if your business nets $70,000, you are going to be paying north of $10,000 in self-employment taxes alone. But there's a solution. Elect to be taxed as an S-corporation. Now, your business does have to be formed as an LLC, a partnership, or a corporation in order for you to elect to be taxed as an S-corporation. You can't just go from a sole proprietorship over to an S-corp, so please keep that in mind when thinking about this strategy. An S-corporation is the only entity that's recognized by the IRS that allows you to save 15.3% self-employment taxes on your net earnings. So of course it's worth mentioning. So an S-corporation allows business owners to take a portion of their net profit as a part as a W-2 salary and the other part as distribution. The W-2 salary is subject to the 15.3% Social Security and Medicare taxes, which essentially make up the self-employment taxes. But the distribution, the other part of your net income that you're not taking payroll, will be considered a distribution, and that money is not subject to the 15.3%. It is subject to the other ordinary income tax rates, the 22-24% that I mentioned earlier. So if we take that same $70,000 of net income from the sole proprietorship, what the S-Corp will allow us to do, we'll take about a $30,000 salary with our S-Corp, and the other $40,000 we will get to take as a distribution, which is not subject to the 15.3%. The $30,000 that you're running through payroll is subject to Social Security, Medicare taxes, which make up the self-employment tax. So again, 15.3% on $70,000 is a little north of $10,000. 15.3% on $30,000 is a little north of $4,500. So that's about a $6,000 savings just by breaking up your income, doing what you're required to do as an S-corporation. You have to take that salary. So there's even a little bit more savings to be had once we put ourselves on payroll, because now that we're an employee of the business, technically, we can contribute to a 401k. So we could take that same reasonable salary that we just took from our business and put it into a 401k and get a pre-tax deduction. So that means it's going to reduce your taxable income for the year. So you're reducing your tax, and if you were to max out the $23,000, that'll be a little bit over $5,000 in savings. So you have your $4,500 plus your $5,000 for contributing your salary to the 401k. That's about $9,500 right there, just by changing your tax status with the IRS. You didn't have to do anything else. So if your business profits are at least $40,000, $50,000 annually, it might be time for you to explore the S-Corp as a tax strategy. So if your business is netting about $40,000, $50,000 a year and you're still a Schedule C sole proprietor, or you're not even filing your business taxes at all, make sure you give Luxury Tax Prep a call or book a complimentary consultation. The link is in the description. I cannot wait to hear from you to see if this strategy or one of our several others are right for you and your business. See you later.